Is the 2% inflation target dead? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Vincent Deluard, Director of Global Macro Strategy at StoneX. Hi, Vincent. How are you?
Hi, Maggie. Happy to be here.
I'm so happy you are here because, as you just mentioned, you are sacrificing watching a really important European football game for us. So we appreciate that sacrifice, Vincent. And
I
you can
appreciate
update
you
us.
using the right word for it, football,
Well,
not soccer.
I'm a global
Okay.
citizen. I'm a global citizen. But very seriously, you can give us an update on the score. But first, we got to talk about the Fed and market. So it looks like U.S. stocks are all going to end with gains after the Fed held rates steady, but said risks to both the economy and inflation were rising. I guess they're sort of in wait and see mode. There's also some news crossing that supposedly Trump's thinking about ending chip export restrictions. That's helping tech a little bit. I mean, the tariff headlines are all over the place. So, don't bake that one in if you're listening to this on repeat. But just generally, what's your sense of what's happening right now? No surprise really from the Fed. But what do you make of it all?
Yeah, for the Fed, I mean, to be honest, I was watching the Champions League game.
That tells you
And
everything you need to know about how
that's
important.
really like, it was clear that this meeting was going to be, kind of wait and see. I mean, I actually faded the June cut as well. I think the market, as usual, had run ahead of itself. Pricing cuts. I love, and every month or so I recycle this meme over Twitter. The one where you see death knocking on doors, and there's like 5 doors. So the first one was the 23 recession that Bloomberg predicted 100% accuracy. Then there was the you remember that great regional bank recession that didn't happen? Yeah. Then we also had the Samuel recession that didn't happen. Now we have maybe the tariff recession doesn't happen. I don't know. I'm really confused about the economy. As you know, from previous calls, I'm having a good year. Called for a March bear market starting in March. And at the time, it was an economic bet. It was just my view that the economy was so strong in Q4, and that many of the things that helped it be so strong in Q4, mostly related to fiscal, would slow. And then we got the tariffs on top of that. I mean, I can't say I called that one, although I do think there's an element of chaos with Trump that the market was completely disregarding in January. So anyway, so that played out beautifully. The economy was slowing, and then in April, the data that I look at started to turn up. And then we even start to see that in the data that everybody looks at, like the non-farm payroll and the ISM and PMI. So I don't know. You have two theory of the case. One is that it's a mirage. There's this kind of boost in activity ahead of the tariffs. This 90-day pause. Everybody who's trying to buy is buying now. If that's the case, we'll see this. It's like a balloon, and it will deflate. And I think we should brace for a bear market in the fall, or continuation. Like basically retrace about 2/3 of the losses, and then we make new lows in the fall. And that was kind of my base case. And now I'm open to the other scenario, which is that there is some sort of resilience in the economy that I don't understand. In the same way that we learned how to live with COVID, we learned how to live with 5% Fed funds rate, 7% mortgage rate. The regional banking crisis somehow will live with tariffs, and growth will not slow that much. If that's the case, it still doesn't make me a bull on equities, because that means that 10-year yield needs to go up. We need to price out some cuts. So I don't really see much upside in this scenario, but maybe of course not as much downside as in the recessionary scenario.
Well, that's interesting. So no good news for equities, but you raise a really important point. First of all, I'm just going to say hi to everybody who's joining on YouTube and Substack Live. Great to see you. Put your questions in, and we'll try to get to as many as we can. You're right, Christopher. Sorry, an email did not go out today. The whole system's down that we use. But if you want to keep track of what we're doing and who's coming on and everything we have in store, sign up to the email. We'll have the link. And if you are not a subscriber, whatever platform you're listening on, if you could, that would be wonderful. It really helps us out. As we always say, fighting the tyranny of the algorithm. We're all trying to do that, but we appreciate it. So So Vincent, this idea that the economy might be more resilient than we think. You're so right. I feel like so many people have gotten that recession call and just been wrong about it, even though you've talked about it. And we're not gonna get into it now. I'm gonna remind everybody, you can go back. We write all of this up on Substack when Vince was talking about the gig economy hidden in the US economy and how it's so hard to measure. And maybe we underestimate that. But the one thing we know is the fiscal side of things, right? We know that that's been such a huge support, this enormous amount of fiscal spending. Is there any way that continues? Or is that inevitably hit a wall in the US? And how problematic is it?
Well, I mean, it depends if you look at the level or the second derivative, right? What people call the fiscal impulse. So one reason for my stagflationary bear market case for 2025 was the view that the fiscal impulse would be negative. Meaning that the deficit this year would shrink, still remain large, but shrink. So far, it's not happening. This is insane. Like, even though the tariff money is rolling in, we are having fantastic tax collection. I mean, in April, we had 8.4% growth in tax collection. This is not something I expected. It was tracking way lower in February, March. It was more tracking to 3%. But April, yeah, people paid a lot of taxes. Maybe some of that was capital gains on the everything bull market from last year. So it may not be that sustainable, but it's big. So we had a lot of tax collection, and still the deficit today, if you compare to the same day last year, is exactly the same. So we have tariffs, we supposedly have Doge, we have amazing tax collection, and we still have deficit of 7% of GDP basically. So why is that? Social security spending up 13%. This is something that, to me, this was the tell sign when Elon started talking about 300-year-old getting social security benefits, and then Trump repeated that during the State of Union. Like, that was a demonstrably false statement, and they knew when they were saying it. So I'm like, okay, if you have to invent fraud, you're not serious, right? You're not going after the right thing. Like, if you invent like that, Social Security doesn't pay benefit, and this was, everybody who understood the topic knew that was a lie. So yeah, Social Security is really going up, and we're getting into the prime age for boomer retirement. I mean, if you look at the live births in the US, the peak was 1964. So these guys are getting eligible now, and that shock is going to last for at least another 5 years. Basically, the baby boom count ends in the late 60s, so that takes us to the late 2020s for the shock. So that's that, but it's not just that. I mean, like, things like the VA, like, why is VA spending up 15%? Like, what war are we fighting? Why the number of veterans keeps dropping? Why are we spending more money on the VA? And I can go down the list. Defense spending, that's another one. Like, okay, we pulled out Iraq, pulled out Afghanistan, we're no longer helping Ukraine. Why are we spending 15% more than last year? Federal salaries up 13% over last year.
Isn't this what Doge was going after, though? I think there's an idea that that if it was sort of mission accomplished with Doge, that this was all the stuff that was going to be taken care of.
Well, it hasn't. That's the quick answer. I mean, they focused on like the headline stuff that didn't matter, like, like cultural war element of it. Like, okay, we're gonna get rid of DEI, fine. We're gonna get rid of USAID, and that's not where the money is. And if you want to go after the money, Social Security, I never expected them to go after it because it's too popular. It would be political suicide. But yeah, I mean, defense spending, we're talking about a $150 billion boost to the budget, first $1 trillion budget. Maybe there's some conflict of interest here between, Elon and
so let me, I mean, and, of course, this quickly can, become a political conversation, and then everyone's ears close. But so let's sort of think about it a different way. Given the deficit situation, so we can talk about growth, we can talk about the outlook for equities. It all seems to be like there just seems to be a huge magnet coming back to this deficit issue, even though we've known about it forever. It seems like right now, that's where the gravitational pull is, which is why everyone's paying such close attention to treasuries.
Yeah.
Do we see some sort of, Congress will not cut them? It just seems like there's no way lawmakers are going to suddenly get serious about reducing the deficit. It's sort of political suicide. None of them seem to have the political will to do it. I ask everyone every time I talk to someone in DC, and it just doesn't seem like that's going to happen. Does the bond market force Congress's hand?
First of all, let me just say, from a purely economics perspective, I view the deficit as positive. I mean, it's
well, that's the other issue that people say.
You can use an equation, right? I mean, aggregate demand. I mean, GDP is, you know, private consumption that's holding up, plus X minus M, which is going to be really, really jumpy as you know, imports get shifted, and then plus the net deficit. So if we had austerity, and if we have spending cuts on top of tariffs, which are a tax increase. Okay, tariff would be, I mean, if we go, let's say we go to 20% average, we don't get the deals. You know, that's $600 billion, so $600 billion tax hike. And if at the same time we kept spending, we would have for sure. I mean, I would expect a recession for sure, because, you know, you're really taking from both the spending and the raising revenues at the same time. So the problem is kind of like, at this point, it's kind of like damned if you do, damned if you don't, right? So if Congress does get serious, then we throw the economy into recession, because fiscal impulse becomes negative. Remember that the public sector deficit eventually turns out in the profits of the private sector. One reason why US profits are so much larger, so much abnormal margins are so much higher in the US than the rest of the world, is because we have this uniquely profligate government. So that's the damned if you do, and then the damned if you don't. I mean, basically, when Biden ran the experiment, he could do it because rates were at zero, at least at the beginning. We had massive excess liquidity with $2 trillion in the reverse repo facility that we could drain without any impact. We could play goofy games with the debt, which Yellen did by kind of front loading it. And foreigners were still buying, kind of. Now we are in a very different situation, right? If we start this at, you know, 10-year yields probably around 4.3 today. The pain point is 4.5, so we really don't have much. Foreigners are selling. The reverse repo facility is all but empty. The Fed is still shrinking the balance sheet. I guess we can keep issuing bills, but, you know, it's like walking on an accelerating treadmill, right? I mean, it's the typical EM kind of playbook. So if they do, they kill demand. If they don't, then I would expect bond yields to start creeping higher, and then if we get 4.75% on the 10-year, why would you own, you know, equities at, you know, 22 times earnings?
Yeah. I think there's some questions about who wants to own treasuries too right now, which is worrying. But let me get some questions in here, and this is from Substack. If the yield curve doesn't steepen on the long side, is this aligned with longer lowering demand for U.S. debt and increasing bearish U.S. sentiment, aka depreciating U.S. brand? That's sort of touching on, you know, I think we've seen a lot of posts on X and people coming around to this idea that there's been irreparable brand damage to the U.S. There is a longer structural move out of U.S. assets, and people don't want to own treasuries.
I'm generally in agreement with that. I think that great rotation is real. I mean, I spend my days talking to pension funds in LATAM, Canada, and Europe, and I can tell you that the sentiment is very very negative towards the US, and I think the damage will keep. You know, even if we get a big beautiful deal and drop the tariffs, these are like elephants, right? So they move very slowly. They were massively overweight US, like massively to a level that is insane. Like you know, I did see some LATAM pension funds that were, you know, 80-90% allocation to the US. I mean, that's even above. You could argue that the fact that the US was like 66% of the global market cap is too much, but like yeah, it was probably closer to 90% in many portfolios. So just going back to benchmark means you have to sell. And then, yeah, these movements are kind of self-reinforcing, right? Because as you sell your U.S. assets, the dollar goes down. Now, if you're a pension fund, your regulator is asking you, well, why do we still have so much U.S.? Like the market's underperforming, the currency is bad. You're adding risk to this. Why is this stuff unhedged? That's probably happening in a lot of Taiwanese life insurers right now. Like, why, you need to hedge that stuff if you're going to have it. So, which is costly. So yeah, this is why these trends of like international versus US, basically they move very steadily over, a decade or so. I mean, for the past 15 years, you didn't need to give, Ray Dalio money. You could just have bought MSCI US and shorted the MSCI X US. You would have made 10% a year with almost zero volatility. And then the decade before, you would have done the same thing with the opposite trade, because this was all about, rise of the BRICS, EU enlargement, commodity boom. And then the decade before, you would have made 10% no volatility by doing the other trade, when the US had the internet bubble, tequila crisis in Mexico, East Asian crisis. And then I can keep going. In the 80s, you would have done the others after the Plaza Accord. So my point is, like, it's a huge wave that lasts for 10, 15 years. And I think, yeah, this is staying. And I would say this is a good thing. And that's the part where the growth bull in me is not dead. Nature is healing. Something that is not sustainable will not be sustained. The world of yesterday was unsustainable. The US accounted for 90% of the world's deficit. Like, come on, we're like 15% of GDP on purchasing power.
So
How
what's
can
the
we
what's the
consume
upside to
90%?
that? So
Pardon
why
me?
is that good news? How is that
It's
good
good
news?
news. It's good news because the dollar was strangling global growth. I mean, Americans don't get that because, I mean, I guess they get that when they annoy Europeans go to Barcelona and then they're loud and annoying, or they go to Santorini, or all the Instagram girls taking the same picture on that. But like for any country that is not the US, other than maybe no, not even any, the level of the dollar is your biggest problem. First of all, because your commodities are denominated in dollars, and second, if you're LATAM or an EM, because you borrow in dollars. So when you have a strong dollar, you have this huge hit to your growth. Conversely, when you have a weak dollar, suddenly you have degrees of freedom again. You can start cutting rates. You can start running a budget deficit. So I think we'll see a productivity boom in the rest of the world as the dollar weakens. I mean, remember all this stuff, for example, about European industry being dead, right? After the Russian invasion, and people would show the price of nat gas in Amsterdam going through the roof. I'll run it this year. I mean, nat gas in euro down 45%. So suddenly, if you're a German chemical, producer, your margins are back. So I think that movement is healing for global growth. It's again, it was not sustainable. The US was over consuming, it was over investing, and the rest of the world under consuming, under investing. So as we fix that, I think there's a positive shock to growth. Which is exact opposite of what the IMF said in their World Economic Outlook in April. They just went crazy and downgraded growth by like, I think it was like $1 trillion. My guys, it's not even $500 billion of tariffs there. I mean, how do you? I don't know what. Of course, it's not an economic statement; it's a political statement. They don't like Trump. They don't like tariffs. So they want to make you think that the world's going to end. My guess is the US. Yeah, there'll be a shock to growth in the US. I mean, I'm not as bullish as I was on US growth, but I'm not willing to get the R word ready. And at the same time, we'll see a acceleration in international growth.
So I'm going to ask this question. I think you sort of just answered it, but I just want to sort of, wrap it up fully. Parenting East West asked, does Vincent believe in the resurgence of Europe story, or does the fragmentation of Europe, multiple languages, multiple regulatory environments, mean it will lag the US and China?
Yeah, it would be my top pick. It was late last year. We had a big move up. I mean, a lot of the things that I expected to happen really happened. The German election, the reform to the debt brake and the German constitution, big euro rally, So I mean, listen, if global equities outperform, Europe will participate in that, but it might be more kind of like the 2007 cycle, which was really led by EM, by China, by Brazil, and then Europe was kind of a um, um, second derivative of that. And yeah, the point that the person suggesting the question are still there. I mean, we have a very deep political crisis in Europe. I would not trust the incumbents very much. One odd thing, though, which is true in Canada and Australia as well, is my view is one of the big risks of a lot of Western democracies is these governments are not popular, right? I mean, there's this global revolt against incumbents. Macron's approval rating is probably 10%. Olaf Scholz was not much above. Trudeau was a joke, and that created a risk for political instability. In a weird way, the election of Trump maybe has brought a lifeline. I think Europeans are very angry at, rightfully so, at the lack of growth, at excessive bureaucracy, at terrible policy making. I mean, everything we did was wrong, like shutting down nuclear, supporting Ukraine so hard, betting everything on China. I mean, we had bad leadership. People are pissed, but the fact that Trump is so obnoxious buys them a lifeline. We saw that in Canada, where Carney kind of came back 20 percentage point gap, made that up. Australia, same story. So maybe the whole EU is not quite dead, and there is a little bit of juice left in that project because of opposition to Trump.
Yeah, it sort of takes that internal anger and directs it somewhere else for a little
Exactly.
while.
It's scapegoating, if you will. Like, oh, now there's a orange man bad. Don't look at what I did for the past 20 years.
Right. It's very competitive. It seems to work for the moment. So you are bullish international stocks, not so much Europe. You like. Where do you see the best opportunity internationally? Because I mean, one of the problems we have, if you have if you sit in the US, is like saying international. I mean, that is such a wide, gigantic basket. Even saying emerging markets, it's like a wildly huge basket. I think we have to get a lot better at sort of separating that out and distinguishing between things. So are there things you think have the ability to outperform in the broad international shift?
Yeah, I mean, we discussed it last time. I remain a believer in the LATAM story as the winner of the trade war, the capital war, and the political wars. And I'm going to speak each one of the three. On the trade war, my impression is that the trade war was won by Southeast Asia. Basically, like the US put some tariffs on China, and then the Chinese either rerouted their export through Vietnam, through Thailand, Indonesia, more investment there. And in Trade War II, the US woke up to that and said, no, we're not going to. If we go back to that crazy Rose Garden formula, the highest tariff rate were on countries like Thailand, like Vietnam, who had. So basically, the idea was to China, like, now you can't do the little, put a sticker, made in Vietnam sticker, and so I think the same effect. This LATAM is going to be the winner this time. So Europe, Japan are hit pretty hard. They're export-oriented economies. They have big surplus. They're going to get tariffs. I don't think it's going to be all that bad, but it's going to hit. The focus on Asia. So you just look, it's like a fight. Who's not in the fight? LATAM is not in the fight. They all at 10%. There's no tariffs on commodities. I mean, for better or worse, these are pretty basic countries, right? I mean, Chile exports copper, Brazil exports oil, soybean, and iron ore. They can also play one against the other, right? So you can expect that if China wants to be mean to the US, they'll shift some of these purchases to Brazil. So the trade wars work well for them. They don't have to pay the tariffs. And then they benefit a lot from the weaker dollar. This is, I get back to this idea. Like, basically every 10 years or so, you see a quote unquote productivity miracle in LATAM that unfolds the following decade. That productivity miracle is just the dollar going down. If you have a weak dollar, yeah, that's great. Like you see the Brazilians, in Disney, in Orlando shopping around, and everybody's partying because everything that they sell is worth a lot more. The terms of the trade improve. And then there's no inflationary pressure. Central bank can cut, consumer credit expands, and you think, oh, this is the country of the future, right? And then, 10 years, the Fed hikes rate, and you realize it was an illusion. So I think we're entering one of these phases where the dollar weakens, and that just, we'll see the stories about, LATAM being the next frontier. Turning to the capital war, I think money's got to go somewhere. And a lot of people, everybody was overweight US. Talking about these European pension fund, Japanese insurers, whatever. I think primarily most of the money is just going to come back, right? It's like the main movement is coming back. But to the extent that people are going to allocate money abroad, China is still, difficult. They will be hit with the tariffs. You don't want to do the US. Still, Russia is not an option. India is quite expensive. And if I think about especially the European banks, the BBVA, the Santander, the conduit is still there to bring European capital, because Europe is still going to have a big surplus. Europe is still going to be wealthy. What we're seeing too is in Europe, we're seeing very aggressive rate cuts. For Europe, this is a deflationary shock, because their exports to the US are going to diminish. And they're going to bear the brunt. The Chinese are going to redirect a lot of their exports to Europe. So they're going to get really cheap Chinese. So it's all clear for the ECB to start cutting rates. Maybe we'll see negative rates. I think Switzerland might have negative rates. So then if you have negative rates, and then you look at a place like Brazil that offers you like 14% overnight, 7% on tips, you could see some of that capital flowing into LATAM. And then the last part would be the political war. And it's related to this argument that I was making earlier that Trump, for Canada, Europe, he boosts the center-left in Cubans to the extent that, if we agree that kind of right-wing populism is good for growth, and that's what probably Europe needs and LATAM needs, that's not great for Europe, right? The fact that, you'll see your Olaf Scholz, who kissed Trump, your Macron, they'll be able just to keep
to muddle on
around. Yeah, muddle through, because you can say, well, you have to go with me because I'm the best against Trump. LATAM is the exact opposite. There is no boost to Lula in Brazil or Petro in Colombia. On the contrary, the ones that seem to be benefiting from this are like someone like Milei or Bukele, or even Sheinbaum in Mexico, who's been quite smart in terms of how she deals with Trump. So that I think one of the big issues with LATAM was political, right? I mean, people didn't trust in Brazil. Lula was just, in a fight really with the Faria Lima and the Brazilian establishment and central bank. You remove Lula from Brazil, money's going to flow in.
So, Vincent, this is such a large question as we're coming to the end, but so it sounds bearish for the U.S., bearish for equities, bearish for treasuries. Is it just bearish, or does it have the potential to become a financial crisis? Because there are some people who are very worried. Anyone who has seen Ben Hunt's tweets this week, talking about, the true enemy is the over financialization of the U.S. Treasury market. And then this has the ability, as this sort of blows up, to wreak havoc on the global financial system. There are people who are worried that this change, which you just described, isn't just sort of a shift now, which can boost global growth. They seem to think something's going to blow up and break just because of the nature of the Treasury market. Do you see something like that happening? Are you worried about that?
I mean, to be honest, I don't think I have the expertise. I don't see, people's balance sheet and how much leverage they have. What I will say is I've heard these stories before and they haven't happened.
Mm,
So I would tend to be skeptical of a big blow up. And yeah, I'm going back to this idea that nature is healing, markets work, humans adjust, and what's happening fundamentally is positive. Like that's why I'm was making fun of the IMF economists.
mm.
From now suddenly being all Cassandras and all that about global growth. If you'd had asked these same people 6 months ago, before they knew the result of the U.S. election, what are the biggest risks? What are the biggest imbalance in the world? They would have tell you. Everybody would have agreed. Biggest problem: the dollar is too strong.
Yep.
U.S.
We heard
overconsumes.
that over and over again. Right.
China oversaves. Europe doesn't invest enough. And then maybe some stuff about climate change. Well, what do we have now? We have a weaker dollar. We have a tax on U.S. consumption. We have subsidies to consumption in China. We have a major investment plan in Europe. And then if you are with a climate change agenda, we effectively have a tax on shipping. So the world is healing. I don't know how, maybe there'll be some accidents down the road, but I trust that over time, humans are resilient. We learn how to live with COVID. We'll figure out, how to live with tariffs. Even the U.S. I mean, I'm in the higher for longer camp. Also, for the reasons you mentioned, we relied on foreigners for a long time, and
Mm.
we need to reprice a lot of assets. And my guess is that the dollar is gonna needs to be repriced down, and yeah, yields are gonna probably reset at a higher level. The term premium is gonna be higher, but one way or another, we'll live with 5% 10-year
Yeah.
yield. And
That's,
I mean, mortgage rates have been at 7% for a long time, and I mean, sure, the housing market is not great, but we didn't have the implosion or the regional banking crisis has been somewhat contained. So I would, whenever you hear these stories of impending doom or something's gonna explode, I would take the under on that.
I love it. Just want to squeeze this last one in because Mark asked, I think, or commented, I think Taiwan is going to be the biggest loser here. China will take it and Trump won't care. You actually have Taiwan on your list, but you're more positive about it, right?
Yeah, no, I don't know if he's watching. I hope he is. That once in a while I get like so he came from Real Vision, your former uh smart kind of entrepreneur guy who subscribed to my work, and we started chatting, guys from Taiwan, and we talked about it. And I mean, Taiwan was on my list for the longest time, and my view was, okay, it's it's been repressed for a super long time, for the same reason that every Asian currency was repressed. Same thing, China is repressing itself. So I mean, if you're Taiwan, you compete with China, okay, this weekend you have to be weak. Then on top of that, you had a discount on the stock market because of the geopolitical uncertainties. They kind of convinced me to pull the trigger a couple of weeks back. And Jesus, yeah. So for those who don't know, the Taiwan dollar, which is usually more respect to the dollar, just rallied by 15%. Who knows what it's about? I mean, some people say it's the insurers. I think that's probably part of it. There's massive surplus, right? If you have another currency, you have a surplus, you got to invest it somewhere. So it makes sense that they were probably buying treasuries since the U.S. rates were higher and the currencies was pegged to the more respect to the dollar. So it was free money, quote unquote. Turned out to be not so free. So yeah, once you, it's like a spring, that has been contained for so long and then it expands. I would stick with it. Now, short term, who knows? I'm, the geopolitical stuff. I don't know. I mean, it's what I see from the people who are in Taiwan. They don't seem to worry as much. I think we have a huge amount of kind of anti-China rhetoric, and part of that is oh, they're going to take Taiwan, and that helps justify having a big budget and having a big fleet. And of course, the Chinese also say the same thing, but they've been saying that since 1949. And it seems to me that the two parties have had this careful dance. There's some red line that they're careful not to cross. So yeah, if your investment horizon is 5-10 years, I would say you want to buy cheap quality asset in undervalued currency, and this is the definition of Taiwan.
Fantastic stuff. And we didn't get into it, but Vincent is also looking at being long break evens based on what we said before. Vincent, I always appreciate, first of all, your research is fantastic. If you don't read it, folks, you should. But I always appreciate your willingness to be contrarian. And it certainly paid off this year, but appreciate you taking a position and sticking your neck out where necessary. But really good food for thought and a good counter to some of the really doomsday or narratives out there. So I appreciate it.
Thanks, Maggie. Hope
Thank you. Soon. What's going on with your score? Did you miss the whole thing? What's happening?
I will tell you right now.
And who are you cheering for? Who's your team?
Oh, it's Paris is up 2-0. They won the first one 1-0. It's 15 minutes left. Paris is in the Champions League final, and they will play Inter Milan, and it will be a beautiful night of football. Everybody should watch it and pay much less attention to the Fed or to Trump's Twitter feed. These things don't matter. Have a beer, enjoy a good game.
I think he's sinking into your psyche, though. The big, beautiful game. Tune in. None of us can avoid it. We're none of us are immune. That's fantastic. I'm glad your squad's winning. Thank you so much, Vincent. We appreciate it. Thanks for all the great comments, everybody. We will see you again here on Friday. In the meantime, take care and good luck out there.